Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel for a forward exchange contract designated as cash flow hedge and redesignated as a fair value hedge. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side, including our journal entries and then our trial balances, which we will have 2 years of because the data will extend beyond 1 year's time frame. We have on the data side of things, we have the forward exchange contract that we will be dealing with. Basic timeline will be the timeline of the forecasted transaction. It's going to happen first, meaning we're forecasting a transaction in the future that will deal with foreign currency. We don't have a contract for it necessarily. We're basically predicting or forecasting a transaction that could happen in the future. That happens on 8/1. X1 forecasted the purchase of goods and entered into a 240-day forward contract to hedge the foreign currency purchase. So that means we're going to enter into the forward contract at this point in time, even though we haven't done the purchase yet, because we're forecasting the purchase to happen in the future. We believe that the purchase, as well as the purchase on account, the total extent of the purchase will end, payment will happen at the end of 240 days. Therefore, we're going to put 240 days and it should end at what we predict will be the ending date of the purchase contract that we will have. Then we have the exposed foreign currency payable. On 10/1/X1, we receive the goods. So now we're going to say we got the goods, have been received at this point in time. We're going to record that inventory. We still have our forward exchange contract that was for the full 120 days. It's still going, but now we have the exposed foreign currency payable because we have not yet paid for it yet. We basically purchased it on account. We'll be paying for it in the future. We'll be paying for it in yen, and therefore we have that foreign currency that we'll be dealing with. Then we have the balance sheet date. So we're going to have to deal with the balance sheet date at the end of the year and revalue our foreign currency information to that current time period. Then on 4/1/X2, the next year, we're going to pay the accounts payable in yen with foreign currency units received from the completion of the forward exchange contract. In other words, the forward exchange contract will expire. It will have yen from that forward exchange contract that we'll then use to pay off the payable that we promised to pay in yen. Okay, so then let's go through this a little bit more detail. On 8/1/X1, let me just adjust this. It should be 8/1/X1. P, that's us, purchase goods from a Japanese company. So from a Japanese company, the purchase is forecasted, but there's no binding agreement for this purchase. So similar to a prior scenario we had, but there's no contract for us to purchase in the future. We haven't received the inventory just like before, but this is basically, there's an agreement. There's no basically contract at this time. That's going to be one of the basic differentiating factors. Then on 10/1/X1, 60 days delivery with it will happen. So now we're going to have the delivery happen 60 days from that point on 10/1. So now we're going to record the inventory on account at that point in time because we haven't yet paid for it. We're going to pay for it in the future. We're going to pay for it with the 3 million yen. Let me move this over a little bit. So the contract price will be that 3 million yen that we're going to pay for at the end after the accounts payable is up, which is going to be on 4/1/X2, which is going to be 100 days after the delivery payment to be paid. So that's going to be the 3 million yen that we will pay. So 8/1/X1, P entered into a 240-day forward exchange contract. That's going to be the 60-day time period that we have before. You can kind of break this out in your timeline. You're thinking about, okay, we think that there's going to be this transaction happening from 8/1 to 10/1 when it will actually happen. That's a 60-day time frame. The forward contract will be covering that. And then it's also going to be covering this point in time when we purchase inventory on account that we will be paying in yen in the future to the point in time that we make the payment, which is going to be 180 days from that point. So forward contract as a designated hedge against the future cash flows from the forecasted transaction, including the foreign currency denomination accounts payable that would result from the purchase. Then we have the future rate for the 240-day forward contract. It's going to be $0.0073 to 1 yen. And then we have the spot rates and the relevant future exchange rates for the relevant time periods that we'll see and use throughout the problem. We have the forward contract designated as a cash flow hedge and redesignated as fair value hedge. And you can that's what we're doing when we're cutting this thing out, this full time frame for the forward contract covering this full period. Again, you can cut this back out in two, where we have the forecasted transaction component, where we're forecasting the transaction that's going to happen, but we don't have a contract for it that's going to be dealing with foreign currency. And then the point in time that we get the contract, and now we're going to have an accounts payable on the books to the point in time that we actually make the payment. Okay, let's work through this thing. First thing is that we're going to predict that we have this future transaction that's going to be taking place with a foreign currency, and therefore we're going to go into the forward exchange contract. So remember, that's going to be here on 8/1. We forecast the purchase of the goods and enter into a 240-day forward contract to hedge the foreign currency purchase. So we're gonna enter into that first, and this is going to be our forward contract. So we're going to put basically an asset, a receivable, and a payable on the books for the forward exchange contract. So we're going to be picking up the foreign currency receivable. We will be picking up the payable, which is the dollars payable to the exchange broker. So we can then pull out the trusty calculator to calculate this thing. Trusty calculator's in the wrong screen. It's up top. We're going to bring that on down. And we're going to say we're going to have the 3 million yen. So we're going to say 3 million yen, multiplying that times the forward exchange rate. So we're looking forward to the future, to the point in time that this whole thing will end, which is going to be at the end of 240 days. So with the forward exchange rate, we're always pointing to April 1st, 2020 or 2000x2. We're always pointing towards that date, and then the countdown will happen as time passes. We'll change our prediction up to that end date, whatever it will be at that end date. So this is a predictive rate. So we have the 3 million times the 0.0073. That's going to be the 21.9. So we'll put this on the books at the 21.9. Let's do that calculation again up top. We're going to say that this will be equal to, we'll pick up the 3 million times, and then we're going to be picking up the 0.0037. So there we have that. There's the 21.9. So we'll pick that up on the debit and on the credit side. Let's do that one more time. So then we have the receivable up top. Here is the receivable. We're going to put that up top here. This is going to be equal to the 21,900. And then we have the payable. That's going to be in the liability side of things. Liability on the payable at the 21.9. Next thing that's going to happen is that on 10/1, we're going to receive the goods. So now we have the inventory. So first we'll revalue this receivable. I'm going to revalue the receivable. So I'm going to say, okay, it's on the books at the 21.9 now. So if we then revalue it, we're now going to be using this rate. So I'm going to say, all right, now we got the 3 million times the next forward exchange rate. We're still pointing to April 1st, but now it's a later time. So we have a different prediction that's 180 days out from the current point. So we're going to say times 0.0075. That's going to be the 22,500. What's currently in there, the 21,900, so minus the 21.9. That's going to give us a $600 difference. That's going to result in income. That's income. Why is it income? Because last time we had the prediction of 1 yen being $0.0073, and now we have 1 yen being $0.0075. So you get more dollars per yen. That means the yen's getting stronger. And we're talking here about a receivable. We're going to get paid in yen, and the yen is now worth more than it was before when we made the contract. That's good. That's typically a gain. So we're going to say that we're going to have the receivable is going to be going up. So we'll increase the receivable. Now this is where it's different here. We're going to say now this is going to be going to the other comprehensive income. So we're going to other comprehensive income. At this point, this is what's basically a different than the prior transaction, in part because this is going to be a prediction that we're going to make the purchase in the future. We don't have a contract, basically, so it's the forecasted transaction. So this is basically P agreement to purchase from a Japanese company. The purchase is a forecasted, but there's no binding agreement for this purchase. And then down here, the key point, forward contract designated as cash flow hedge, and then it's going to be redesignated as the fair value hedge. Let's calculate it again. So we're going to say this equals then, we'll do this calculation a little bit differently. We're going to say the 0.0075 minus the 0.0073. Let's put brackets around that. So I'm going to bracket those items. The difference between those rates times the 3 million, that will calculate once again, that's 600 on the debit and the credit side. Let's go ahead and then record this out, pulling the calculator out of the way to do so. We have the foreign currency receivable up top. I'm going to double click on it, go to the end of it, say plus, pick up that $600. So there we have it, bringing it up to that $22,500. The other comprehensive income then going down below, this is going to be equal to that $600 in other comprehensive income. That $22,500 then of course can be calculated as we saw being the 3 million times the 0.0075. There's that 22.5. So there's the 22.5 once again. So next thing we're going to have is that we're going to get the inventory. Let's record the inventory on the books at this point. So inventory is going to go up. We are in essence purchasing it on account. So we have our normal kind of transaction, inventory going up, other side going to the accounts payable. However, the accounts payable represents the fact that we're going to be making the payment in yen. So we're going to make the payment in yen, even though we're going to value it in our books at the US dollar equivalent. So we're then going to put it on the books. This is going to be the normal calculation we'll have down here for when we make the purchase. We're going to use the spot rate. Even though we're purchasing it on account, even though the payment's not going to happen until April 1st, we're basically valuing the inventory at the point in time that the agreement was made. So we're then going to be taking the 3 million times the spot rate at this point, which is 0.007. 0.007, that being the 21,000. Let's go ahead and calculate that again up top. So I'm going to say this will be equal to, and we will pick up then the 3 million times the spot rate right now, which is 0.007. 0.007. There's the debit, there's the credit. Let's go ahead and record this out. We have the inventory up top in the assets. This will be equal to then that 21,000. Then we have the accounts payable. Accounts payable in yen is going to be the credit, which will be going up by, once again, the 21. I'm going to put some little notes here so you can see these if you're working in the Excel worksheet. If you want to write in these notes, I'm making them colorful with the red here and then italicizing them, which is one way you can do the notes. I also recommend, if it's your worksheet, that you right click and make notes in this format by basically just making a note. Maybe you want to put it on the date, or you can put it anywhere that's standard to you to do so that it'll pop up and it won't always be there, and you can save some space to do that. But I want to make some very, very explicit notes here that you can see. And sometimes this is nice to have too. If you really want someone to see it, you can put the notes in some other text underneath the transactions that you will be making. So we'll put these notes here. And so I'll type it in really fast. So typed it really fast there. Okay. So then we're going to go to 12/31/X1 is going to be the balance sheet date that we're going to have to account for and adjust the foreign currency amounts as of that point in time. We'll have to do that for we're going to do that for the receivable here. So that receivable for the forward exchange contract and the payable will have to be adjusted because we're going to pay that in foreign currency. We will not be adjusting the dollar payable to the exchange broker. That will remain the same until we actually pay it at the end of this whole thing, which is going to be 120 days since the start at 8/1. So let's do the receivable first. Let's take a look at this. Receivable is at 22,500. We'll revalue it as of 12/31. So we're going to go on down here. We're going to say the 3 million once again times the current forward rate. It's December. It's going to be that 0.007 times 0.0077. One more 7. Is going to be the 21.3. So I got the 23.1. Sorry about that. A little backwards there. That happens to me. So then I'm going to say minus the 225. And that's going to be the 600. So we have a 600. That's going to be resulting in a gain. So why is it a gain? If we scroll on down here, we're going to say, all right, well, last time we had the forward rate was 1 yen was worth $0.0075. Now 1 yen's worth $0.077. So the yen is worth more dollars now, so it's gotten stronger. We're talking up here about a receivable. Therefore, we're going to get paid in yen. We're going to get paid in something that is now worth more than it was when we had the original contract or the last time we looked at it. Therefore, we're going to have a gain. That's good. So we're going to say, all right, then this is going to be the foreign currency receivable is going to go up. The other side's going to be going to the gain. I'm going to record on the other side. We'll then we'll calculate this again. It's going to be equal to, I'll put brackets around this thing, equal to, I'm going to take the bigger of the two numbers we'll deal with, which is the 0.0077 minus the 0.0075, closing up the brackets, multiplying it times that 3 million. So there's going to be the debit, there's going to be the credit. Let's go ahead and move the calculator out of the way so we can post this thing. So we're going to go up top to the foreign currency receivable. Up here, we're going to double click on it because something's in it. We're going to go to the end of it, say plus, pick up that $600. Then we have the gain. We're going to go down to the gain on down below in the income statement. This is going to be equal to the 600 on the gain side of things. And then we currently have in the receivable that 23,100, which again is calculated as the 3 million times the current forward rate 0.0077. So that was the 23.1 that we needed to be at here. Okay, so next thing that we're going to deal with, we're going to do a similar kind of thing for the payable, similar type of activity for this payable that's at the 21,000. So it's at 21,000. We're going to scroll on down and say, all right, well, this one is going to be the 3 million. Should be 3 million times the current point, but now using the spot rate for this one, so times the 0.008. 0.008 is 24,000. We currently have in there 21,000, so minus the 21,000 is going to be a $3,000 difference. That's going to be a loss, which we would expect because it's the opposite of what this one was up top. If we analyze why it's a loss, we're going to say, all right, well, last time we had the spot rate of 1 yen was worth $0.007, and now 1 yen's worth $0.008. So the yen's gotten stronger in comparison to the dollar. And up here, we're talking now about a payable, which means we're going to make a payment in yen. So we're now paying in something that's worth more than it was when we last time we checked on this thing. So that's going to result in a loss. So we're going to say that then we have the loss. I'll put the loss on top. So we'll pick up the loss here. Then the other side is going to be going to the payable, the accounts payable. And then we'll calculate this again. We'll do this with the equals brackets, scrolling on down. And we're going to then be picking up then the 0.008 minus the 0.007, closing up the brackets, multiplying times the 3 million yen. And we get that 3,000 on the debit side, which we also want on the credit side. We're then going to move the calculator out of the way so we can post this thing. We have the foreign currency loss. That's going to be here, foreign currency loss. Notice it's not going into the other comprehensive income at this point in time as it did before we received the inventory. So we're going to say, all right, now we've got the loss, and then the other side's going to the accounts payable up top. So something's in it, so I'm going to double click on it, go to the end of it and say plus. And then pick up that 3,000 on the accounts payable. We're now at that 24,000, which one more time we'll calculate that 24,000. You'll recall as the 3 million times the current spot rate 0.007. No, that's not it. 0.008. This spot rate right there, and that's the 24,000. So that's good. That looks correct. Now we're going to go into the next year. So the next year we're now in, because the next relevant thing happens on 4/1 of X2 the following year. So we're going to take our ending balances as of the current year. We're going to make those our beginning balances for this year for the permanent balances. And we will then have the net income roll out into the equity section. I just made a slight adjustment to make that correct. So we're taking this whole equity amount is in the current section. So this is like a post-closing trial balance or the beginning trial balance. Nothing is currently in the temporary or income statement accounts as we go into then year 2. Let's go ahead and unblue this so we have a nice line in between these. Okay, so now we're in year 2. Maybe we should even make this like a more solid line here. Let's even make this black. So all right, so now we're on year 2. Okay, so on 4/1, then we're going to say that this thing is going to end on 4/1. So we're going to have to revalue these items again. So we're going to do a similar kind of process. Let's revalue the receivable. Let's revalue the payable, and then we'll go from there. So we're going to say, all right, well, now it's 4/1, and now the receivable was on the books for 23/1. Let's actually measure it. We're down here, the same 23/1 down here. So now we're going to say, but now it's April 1st. So now we're going to take the 3 million times the current rate. Now there's no forward rate anymore. We were using that before, but now the date is April 1st. So it's April 1st. So there's no forward rate. All we have is the spot rate. We're here and now. There's no looking forward. It is what it is as of this point in time. So we're going to take the spot rate times 0.0076. There's the 22.8. We've learned to calculate the 22.8. So then we have the 23.1 is currently there. So we're going to say minus the 23.1. And there we have a $300 difference. That $300 difference is going to result in a loss. Why is it a loss? Because before we were using the forward rate on December where 1 yen was worth $0.0077. But now 1 yen is going to be worth $0.0076. The yen's gotten weaker, and we're talking about a receivable here. We're going to get paid in yen, so we're going to get paid in something that's worth less than it was like before, so that means we're going to have a loss. So we're going to say, all right, we've got a loss here, and then the other side is going to go to the foreign currency receivable there. Let's calculate that amount one more time. We're going to say equals brackets. And then I'm going to take the bigger of the two rates we'll be dealing with. The last time it was this forward exchange rate, but now it's the spot rate because it's the end of the time period. Closing that up and multiplying it then times the $3 million. There's that $300 once again on the debit and the credit side. Let's post it out, moving the calculator out of the way to do so. We've got the loss. The loss is going to be down here on the income statement side of things. We're going to be debiting that loss down there, which will affect the net income. Then we've got the foreign currency receivable is going to be going up top. This is going to be equal to the $300 up there. We're now at that 22.8. How do you calculate the 22.8? It's going to be the 3 million times the 0.0076. We're going to calculate that 22.8 multiple times. It's going to be great to calculate the 22.8. Okay, so then the next thing we're going to do a similar kind of process with the accounts payable. So the accounts payable we have here at the 24,000. But once again, what does it need to be? It needs to be that 22.8. Why? Because we're using that same spot rate now. We're all ending at the same point because we're at this point in time. So we're at the 3 million times the spot rate 0.0076. And what does that calculate? The 22.8. All right, so there it is again. So then we're going to say this minus the 24,000 means we have a $1,200 difference. That's going to be a gain this time. Why? Well, one, it's going to be the opposite of what we had up here. That's what we would expect to happen. And then also, if we look at this, we're going to say, well, last time we used the spot rate for this one, which was 1 yen versus $0.008. And now it's 1 yen versus $0.0076, which means that the yen has weakened. It's gone down in value. And this time we're talking about something that we're going to pay, a liability that we're going to pay in yen. And the yens are now worth less than they were before. So we're paying with something that has less value than it originally had or it had last time we checked. Therefore, that's good. We have a gain there. So we're going to say then the accounts payable is going to go down with a debit. And then the other side is going to be a gain. Let's calculate it again. We're going to calculate it by saying equals brackets, and then we'll pick up this this change once again. we're going to be picking up the 0.007. Let's pick up the bigger number first, so it's a positive. Minus the 0.0076, closing up the brackets, and then multiplying times, well, I forgot the multiplication. F2, then times, then F2, and then we'll pick up that 3 million. There it is. There's that 1,002 on the debit. Let's pick it up on the credit side. Let's move the calculator so we can post it out. So we have the accounts payable up top. Accounts payable is going to go right here. We're going to say that's be equal to the 1,200. Then we have the gain. The gain on the income statement side of things is going to be equal to that 1,200. We now have that 22.8 in the accounts payable. Once again, how do you calculate the 22.8? How did we get there? 3 million times the spot rate, 0.0076. There's that 22.8 that we learned to calculate. All right, so then we have the, we're going to say that we're going to pay off the exchange broker account. Now, remember, this one is in dollars. Like, this one hasn't changed when we had the forward contract. I'll just put a little note here. It's in dollars. So in other words, when we originally had the forward contract on the books up top, we put this 21.9 there, and it hasn't changed. We just owe that, like we just said, hey, we have a liability in dollars, and we're going to pay those dollars at the end of the time period, which is 240 days, ending on 4/1/X2. Now's the termination date. We paid off. Nothing funny, nothing fancy. We're just going to reduce the payable here, and we're going to be reducing the cash. So no foreign currency kind of funny business happening. And I could just say negative of this number because we're just going to pay that off with cash if you want to recalculate it to see it. Or you might want to tie it out to this number just to see where it, originally was calculated from. Or you could recalculate it, which would be equal to the 3 million times the forward exchange rate that we had when we first put the forward contract on the books. There's that 21.9. There's the debit, and there is the credit. Let's go ahead and post this out. We're going to go up to the cash up. Well, let's go to the payable. So here's the payable. It should then go down to 0. So there it is. That goes down to 0. Then we've got the cash is going to be reduced. We're going to put that in the cash here, crediting the cash by the 21.9, reducing it. So we are back then in balance. So now we're going to say that the other side of the forward exchange contract, we're going to get the actual currency in foreign currency. So in other words, we had a receivable on the books for the foreign currency receivable from the exchange broker, valued at 22.8. Now remember, what we're actually going to get is the 3 million yen, which we have currently valued at $22.8 using the current spot rate. So now we're going to receive the 3 million yen. We're actually getting yen, and then we're going to record it in our books at the dollar equivalent. So we're going to say, all right, well, it's just like any other asset. You might as well be calling this like, it's called foreign currency units in yen. You might as well just be calling it like if it was stocks or something like that, which is value. It's a pretty liquid asset, but we're going to value it in so whatever units it has, we're going to revalue them in dollars. So then the other side is going to be the foreign currency receivable going down, and it's going to be for that 22.8, which we can calculate once more, as if we want to. We can calculate it again, and why wouldn't we? Why would you not want to calculate the 22.8? It's going to be the 3 million times the 0.0076. There's the 22.8 on the debit and the credit side. Let's go ahead and post this out. We have the debit going to the foreign currency in units. That's going to be this item. It's going to go up by that 22.8, and then we have the receivable on the other side of things. Here's the receivable. Something is in it. We're going to go to the end of it, plus picking up that 22.8, bringing it on back down to 0. Okay, so next we're going to have then the accounts payable. So we're going to be paying off the accounts payable. Why? Because now we have the 22.8 of the foreign currency, which we're now going to be using to pay off the accounts payable. So remember here, the accounts payable means we're going to be paying this off in 3 million yen, which we have now present valued to 22.8 using the spot rate, and we're going to pay it off with 3 million yen, which we have reflected in this account, valued in dollars at the same 22.8. So we're then going to say, all right, so now we're going to take this thing off the books. We're going to say we're going to have a debit to the accounts payable. We're going to have a credit to the foreign currency. It's for that 22.8. And yes, we'll calculate the 22.8 one more time. So the 3 million times the 0.0076. So this is the last time. Savor it. We calculate the 22.8. And there's going to be the debit and the credit. Let's go ahead and post this out. We're going to go to the accounts payable. Something is in it, so I'm going to double click on it, go to the end of it, say plus. Then we're going to pick up that debit of the 22.8, bringing this on down to 0. We then have the credit going to the foreign currency in units. Here it is, double clicking on that, going to the end of it plus, picking up that 22.8 on the credit side, bringing it on back down to 0. So now we want to consider what would happen if we assumed the sale, like let's pick up the description here. I'm gonna put this like underneath where we're gonna assume a sale of inventory and a culmination of the earning process of other comprehensive income from the forward contract. And in that process, this is what looks a little bit funny. We're gonna basically remove the other comprehensive income, which I basically rolled into the net income here. So note, we're going to take down the other comprehensive income. So I'm going to record the other comprehensive income here, and that's going to be the 600 that we put into it related to this. So we're going to say this is going to be equal to then that 600. Then the other side is going to be going to the cost of goods sold. So in other words, this at the end of the process, at the end of the sales, we're closing out, basically removing the other comprehensive income of the 600 and including it into the cost of goods sold at the point in time that the inventory is sold and then off the books. So if we record that, I'm going to include that basically in the retained earnings because I rolled them in here. So we're going to include other comprehensive income up top, and then we have the cost of goods sold at the 600 here. Then, of course, we'd also have the cost of goods sold related to the inventory going down. So we'd have cost of goods sold and inventory if we assume the sale here as part of the sale. So obviously, the first half of the transaction, sales, would be a credit. We're going to debit accounts receivable or cash, and then this would be the other side of the transaction, which we're concerned with the inventory and the cost of goods sold, and then the effect that's going to be involved in this other comprehensive income. So that this is going to be then what is in the inventory, which is the 21. So this is going to be equal to the 21,000 if we assume it's sold, the debit and credit there, then cost of goods sold, double clicking on it, something's in it, going to the end of it plus that 21,000. And then the inventory is going to be equal to the 21,000 here. So note here, all the equity was rolled out here. So if I were to just put equity rather than retained earnings can be a bit misleading. We'll just call this equity here, and that might make it a little less misleading as we think about that other comprehensive income component. And then I'm just going to copy this and put that down below as well. Okay, so the end of the day here, then we've got the cash here. Then we have the foreign currency units is now back down to 0 because we've paid them off. We've got the units from the forward exchange contract and used them to pay the accounts payable that we owed for the inventory that we purchased. Then we've got the foreign currency receivable from the exchange broker that is now back down to 0 because we received it at the end of the forward exchange contract. The inventory is now back down to 0 because we're assuming basically we sold it. So we took that one last step to see what the effect would be on the comprehensive income. Notice the inventory is on the books. If we look up top, it's on the books here at the inventory at the point in time that we actually received it. And then it didn't really change from that point in time, right? We said, okay, if we pull up the trusty calculator, we had the 3 million times the 0.007, because this is when we actually got the inventory on 10/1. That's the spot rate. That's the 21,000. So it didn't change from there. However, we did record this other comprehensive income, because of the forward contract before we got the inventory. And now when we sell the inventory, we're going to take the inventory off the books. So we took the inventory off the books down below, as we would in the normal sales process, recording cost of goods sold on the other side. But then we took out the other comprehensive income, decreasing it at that point in time, and recording the effect in the cost of goods sold at the point of sale. So in other words, this effect is not in the inventory, not reflected on the balance sheet, but instead reflected in other comprehensive income, but will be reflected on the income statement in cost of goods sold once the related inventory is sold. So then we have the inventory. We've got the accounts payable is now back to zero in the yen because we paid off the $3 million at the end of the accounts payable turn. The dollars payable to the exchange broker, which is part of the forward exchange contract, now back down to zero. Nothing in the firm commitment. The equity now at the 97,600. The effect on the foreign currency transactions here, as well as the assumed sale, only recording the cost of goods sold, not the sales side in our practice problem there. Note again up top the adjustment that we had up top, the difference of when we're going to be recording to the gains for the foreign currency as opposed to the effect on the other comprehensive income. This being due to basically having the forward contract designated as a cash flow hedge and redesignated as a fair value hedge, basically thinking that we have a forecast and not a commitment, not a contract to make a sale in the future before it actually happened on 10/1 when we received the inventory.